I'll just give you a quick rundown of the results for the half year, ended 30 June. Look at a few of the highlights, what we're seeing in the half year, what that means going forward for the next few years, and then take Q&A. This next slide I've just moved to talks about the traffic growth story that we had in the half year. It's been very strong. We had 7.7% international traffic growth half on half this period, which is very pleasing. That builds off very significant growth in 2016 that we reported as well. We've seen really good capacity come through. We've had 930,000 seats, new seats announced just in the past 6 months or so. So that continues to build a lot of capacity coming through to Sydney. One of the highlights, particularly in the last 12 months, has been the strong inbound traffic growth for international. So that has exceeded outbound traffic growth. So it's been over 10% on a rolling 12-month basis. So we've got very strong inflows of people for business and pleasure coming to Sydney in particular. So that's been a pleasing trend. We've had very strong growth out of Middle East and Asia. Asia has been a big story over the past number of years. We've had bilateral loosening perhaps a couple of years ago out of China in particular. China continues to be a very big story for us. But a number of Asian destinations and origins have been very pleasing in terms of growth also. We've had new routes and services launched. We've had new routes announced in the first half to China, also Vietnam. So again, sort of a Pan-Asian growth story has continued into this period. Also, what we've been seeing is load factors. So the number of seats filled has been very pleasing and perhaps surprised us a little bit on the upside in the past year or so. So we've had this surge of capacity from all sorts of different destinations. But what we've been seeing is, in our minds, airlines being able to fill those seats quite well. So the fuel prices around the globe have been pretty good, as you've seen. And I think the ability of airlines to fill those seats at attractive yields for Sydney as a destination has been a strong theme that we've continued to see in the half year. Moving through just a bit of a run around the ground on our operating results for the half. So EBITDA for us was up about 7.7% when we excluded the tail of Western Sydney Airport costs. Just to remind everyone, we announced that we wouldn't be proceeding in terms of Western Sydney at the start of May, and we had just a tail end of costs there. So a very pleasing earnings story for us. Just to break that down a little bit by unit. So aeronautical, that was up 9% and then 8% when I add in security recoveries. So that was a lot about international passenger growth. So 7.7% international passenger growth. We had 1.3% half on half domestic growth. So very much an international story. But the charges and the economics for the airport are very much in favour more of international growth than domestic. So that was a pleasing result for us. Also on retail, we had quite a step change and some outcomes that were very pleasing in the half year on a few of our terminals. So passengers coming through Sydney Terminal 2, that's the Virgin, Tiger and Jetstar terminal, would have seen a very much enhanced food and beverage offering that was contributing to our bottom line during the half year, having completed that last year. At Terminal 1, so the international terminal, duty free is the mainstay of that, and that's been building for the last couple of years since we recontracted in 2015. But what we also particularly saw this half was some pleasing outcomes from new stores. So we've got what we call a luxury precinct or specialty retail that's talking to the outbound Australian market, but also the Pan-Asian market. So we've got Tiffany, Rolex, Hermes, a number of stores that have been implemented in the past, say, 12 months. And we have had a noticeable kick up in terms of sales there. So that was pleasing. Also, the food and beverage offering at Terminal 1 airside. We did a lot of works that culminated in 2016. We lifted the roof, changed the whole look and feel that you'll probably see as you go through Sydney Airport, and that has totally revamped the opportunity for food and beverage airside. So we've seen a bit of a step up there too. So retail was quite a strong story for the half year. A lot of things, a lot of management initiatives coming to fruition. In terms of property and car rental, that was up half on half, 3.3%. So if I just step back for a second, aeronautical and retail are very much passenger linked, whereas property and to some degree car rental, car parking, ground access are not so much passenger linked. So firstly on property, we had a lot of leases renewed, so a very steady story in terms of property in terms of the half. At the very end of the half, or in fact feeding into the numbers for the next half, we actually acquired a hotel. So the Ibis hotel in the domestic precinct. And we also completed the build in the half year of the new Mantra Hotel at the domestic terminal or near the domestic terminal. So hotels are an interesting new adjunct to the property story out of the airport. Just quickly on that, it's very much a 7-day-a-week proposition in terms of hotels out there. It's not sort of the 5-day-a-week, perhaps CBD story. So the occupancy levels are very strong. The EBITDA margins are very strong because we're really trying to hit a certain type of market there. We're not trying to be all things to all people. People want a clean room, well located at the right price point, and so we're really providing into that market. So that's an interesting growth chamber in terms of the airport in the medium term. There's potentially some more sites for us there. In terms of car parking, predominantly that's a domestic story rather than international. So domestic passengers grew at 1.3%. Car parking and ground transport revenues grew at 2.2%, which was an okay result. We're not seeing perhaps the 4 or 5% growth that we saw a few years ago. There's a number of reasons for that. We've had modal shift to the train. That's been a bit of a theme in the last 12 months or so. We had perhaps 20% patronage increase on the train to the airport over the last 12 months. But that's been a very important part of actually facilitating the growth we've seen in both domestic and international. Over 90% of our passengers don't park at the airport, but let's say 80% or so of people coming to the airport do so by vehicle. So we've also had some mode shift from taxi into Uber and rideshare. We've actually provided new facilities for that, so you can have a quick sort of premium pick-up drop-off in the domestic. We've also got guaranteed spaces, which are more at terminal. So we're actually changing the mix of product in car parking. But certainly there's been some headwinds, I guess, and some mode shifts. Also in Sydney, speaking of Sydney in particular, I think people with the disruption in the CBD, a lot more people have been trying the train in terms of business travellers in particular, and there's been more services announced on the train. So car parking, the story for us is really to continue to optimise the mix and to provide what customers want. But certainly the train is something that we have in fact been encouraging for a period of time because it is a critical piece of maintaining or servicing the growth that we've seen. So that's a bit of a rundown of the numbers. Just moving through, importantly on distributions, we actually increased our guidance for FY17 to 34.5 cents per security. So that was a 1 cent increase in terms of our previous guidance for this year. Why were we able to do that? Well, we were seeing really strong passenger numbers in the first half, as I just mentioned, and those load factors continuing. Also, we had a refinancing in April this year with some pleasing outcomes there. So a number of factors have really given us enhanced confidence or continued confidence in the outlook for the remainder of the year. Also, in terms of passenger numbers for the rest of the year, we don't provide guidance as such on that, but what we are seeing through the slot filings is about 5 to 7% international growth coming through for what we call Northern Winter. So look, we're feeling in good shape in terms of the FY17 outlook. What that's meant though has been distributions 11% up year on year in terms of our new guidance, and also we've been able to deliver very pleasingly a 10% compound growth over the past 5 years in terms of distributions. So hopefully that's been a very sustainable and predictable but attractive growth trajectory, and obviously our ambition is to continue on with that. Moving through just to balance sheet for a little bit. In 2015 we acquired the T3, so the Qantas terminal, and we onboarded that within the balance sheet, which had a bit of a spike in our metrics. You can see in that chart on the top right. The balance sheet's in really good shape. We're actually at a BBB flat equivalent rating from both S&P and Moody's, but we're actually running towards the very top end of the metrics for those agencies. So we do target a minimum of a BBB flat equivalent, but it's not out of the realms of possibility that we might be upgraded by one notch in due course, because we are running quite strong metrics. We don't target an upgrade. We actually get very good pricing performance in terms of those markets as it is. But nevertheless, that might be a pleasing affirmation in due course of the strength of our balance sheet. We have about $1 billion of undrawn debt facilities, and we only have $317 million of debt maturities this decade, having done our refinance earlier this year. So we feel that we've got good flexibility to potentially bring forward additional capital investment, which I can talk about now. This slide here just spells out a couple of areas that we have been or will be potentially investing in the nearer term. Since 2002, so since privatisation, the airport's actually invested over $4 billion in various facilities to enhance the experience, to enhance capacity of the airport, and also to bring additional choice to consumers. And predominantly that has been aeronautical, so over 70%. In the current 5 years to 2021, we're guiding about $1.3 billion of capex to be spent, and predominantly that will be aeronautical again. So this slide just outlines a few areas that we've been recently active in. So check-in hall, baggage system enhancement, expanded gate lounges, our busing services as well, because we've just had so many new services, it's not possible to have every service on gate. And so we've been enhancing those facilities. We're using technology as well, so the processing times through departures in particular has increased, or so has been enhanced very significantly in the last year or two. Now, that's all about enhancing the passenger experience. We're also doing more things as we speak, again, just looking to enhance that further. We're always doing further works on airfield and apron to streamline operations out there too. So there's a lot of activity underway. Now, if I take the lens further out or step back for a minute as well, just to round out, this slide really here talks about our development opportunities, perhaps longer term, in order to serve future growth. We have a range of options in terms of terminal adjustments or enhancements or even step changes, aircraft gates, commercial and also ground access opportunities. So on the left-hand side of this, this slide really talks about what we potentially will be doing or likely to be doing at Terminal 1, so our international terminal. So what we'll be doing is adding substantial baggage and passenger capacity processing, and expanding the dwell space. And we're also looking to provide 4 new aircraft gates on what we call Pier A. And some of those will be A380 ready gates. So we're actually bringing this project most likely forward compared to where we thought previously because of that growth we've seen in the last number of years in terms of international. So we're actually working through that and consulting with stakeholders as we speak. On the top right, if you look in the domestic precinct at Sydney, there's what we call Terminal 4, which is congruent with our master planning process. But really that speaks to potentially integrating terminals for our home-based carriers, so Virgin, Qantas Group, and also integrating possibly under one roof international and domestic activities. That provides a huge opportunity for enhancements to efficiency for what they do, and the potential for us to reimagine what the terminal facilities in domestic look like. So that's a huge opportunity. T4, as we call it, is, as you can see on that really moves on the, sort of the top of that slide into what we now have as the Qantas jet base, which has been leased to Qantas for many decades. That reverts to us in 2020. So the activity in that space probably will really kick off in earnest in terms of delivery beyond that date. Also, other developments, we're also looking at remote bays, bringing fuel to remote bays, i.e. aircraft that stand off the terminal, again, facilitating that growth story. So we're always looking at those opportunities too. And then in the right-hand side of the slide too, again, subject to product requirements and growth in the longer term, we do have a fair bit of space available for further terminal activity. And so we've sort of conceived the prospect there of perhaps a lower cost opportunity in the longer term, again, subject to what airlines and airline groups are doing and thinking about in terms of product. So that very quickly is I guess what I wanted to talk about, just to talk through the numbers for the half, talk about a lot of investment that we're doing right now, and the final slide obviously foreshadowing quite a bit of investment in the medium to longer term to continue and to enhance the opportunity and the experience at the airport. Thank you very much.